All right, everyone. Once again, thanks for joining us for our Single Security Initiative webinar. We've got some good people in the room here, and we're ready to get started. So I'd like to introduce Bill Berliner, our Director of Analytics, who will be leading the presentation today. Bill, thanks for doing this for us.
Super. Thank you, Ian, and thanks to everyone for tuning in. I will try to keep this fairly succinct, but please, at the end, feel free to send in to us any questions you might have. So just to start, what we're going to talk about in this webinar is, first of all, the rationale behind the initiative, why the industry would go through this major reorganization. How the structure of the industry will and won't change, how pooling, trading, and delivery will be affected, and what lenders, as well as other entities that are involved in the MBS market, are going to have to do to prepare for this. The information that were used in creating this webinar comes from a few different sources. There are the Single Security Initiative Market Adoption Playbook, which you can access online, although we'd be happy to provide you with a copy. Most recently updated in May of this year. The information is also taken from the materials at the conference that was sponsored by Fannie Mae and Freddie Mac, also in May of this year in New York. And we also have data from the data and trading platform providers, mainly Bloomberg and Tradeweb, as well as the separate Thomson Reuters Union Icon. And thanks to the people at Bloomberg and Tradeweb for their help in providing materials for this. So the first question is, okay, what is this Single Security Initiative, and what isn't it? It is not a merger of Fannie Mae and Freddie Mac. They're going to remain separate companies, operating separately, regulated separately, separate balance sheets, et cetera. But they're going to issue mortgage-backed securities under a single common platform. And the pools that they're going to be issued going forward are going to be issued under the Common Securitization Platform, or the CSP, as one of the acronyms you may see going forward. The new securities are going to be called Uniform Mortgage-Backed Securities, or UMBS. Now, what's interesting about them, the new securities are essentially going to be identical to existing Fannie Mae pools. Most importantly, they're going to have 55 delay days, and we'll talk about exactly what that means for people who aren't familiar with that later in this discussion. Now, the pools are going to be backed by loans guaranteed and issued by either Fannie or Freddie, and the pools themselves, the level 1 pools, the initial issuance pools, are going to be Fannie-only loans or Freddie-only loans. It's not going to be commingling of loans within the pools. They'll be issued under the same platform, but they'll be Fannie and Freddie pools, identifiable that way. Now, the go-live date, which you can highlight on your calendars, is going to be June 3rd of 2019, the first business day of June in 2019. Okay, what is the Common Securitization Platform? It's going to basically, the securities that are originated are going to be originated through this CSP, this common platform. Early in the process, there was some thought that maybe they could take existing technologies and adapt it to the purpose of issuing under a single platform, but they quickly realized that that wasn't going to be realistic and effective and the right approach. So they created a new standalone platform for originating the securities. And actually, the CSP is being built and will going forward is going to be managed by a joint venture between Fannie and Freddie, which is called the Common Securitization Solutions, or the CSS. It's an LLC that's basically been funded by Fannie and Freddie and populated with various people. So again, if you see some of these acronyms, also another one, people also talk about the SSI, the Single Scuritization Initiative. They're all kind of talking about the same thing with slightly different emphasis. Who is impacted by it? Okay, or more importantly, it's who is not impacted by it. The initiative only impacts conventional fixed rate MBS. So basically, conventional ARMs are not impacted, and Ginnie Mae pools and issuance is not impacted at all. It's everything that would be issued, has been issued under Freddie Mac and Fannie Mae's umbrella, will now be issued under this UMBS umbrella. So what's the purpose of this thing? Why do they feel like they needed to do this? The objective it was and is to create a level playing field for MBS issued by Fannie Mae and Freddie Mac. Okay, so by creating a single securitization and trading platform, Fannie and Freddie will receive the same proceeds for the sale of their securities, because their securities, in theory, are going to be indistinguishable. It addresses persistent differences in the market pricing between mortgage-backed securities issued by Fannie Mae and Freddie Mac. And we'll talk about that a little bit in terms of how MBS have traded historically in the market. As I mentioned, it's not a merger of Fannie and Freddie. They'll continue to operate independently. They'll continue to buy loans independently. They'll have their own underwriting and pricing systems, but their securities will be issued through the CSP. The question, one of the reasons, why is this so complicated? What's the big deal? And the main reason is Fannie Mae and Freddie gold pools have different cash flow structures. The loans themselves are pretty much the same, but the cash flows of the pools are different. So investors, especially because Freddie is kind of the little brother of the enterprises, investors are going to be able to need to trade the $2 trillion approximately in gold securities outstanding without disruptions. The total conventional Fannie and Freddie pools outstanding is in the neighborhood of $5 trillion, with $3 trillion being Fannies, about $2 trillion being gold. If they want to transition to this and have them be indistinguishable, they basically did it where the industry is kind of transforming Fannies to the new one, and Freddies have to be changed over, as we'll talk about. Creating this required a means of converting existing gold pools into new UMBS pools, and we'll talk about exactly what that means. There's a lot of entities that are involved in the MBS market that have to be brought up to speed on this, which is why the preparations have taken so long and why Fannie and Freddie are being so painstaking in publicizing this and discussing it, and why we are actually going out to our clients and contact people to talk about this. Custodial banks, clearing firms, broker dealers, all the online trading platforms are all going to have to transition to this new environment. Okay, so that's just a little background, and apologies to anyone who knows this stuff and has been familiar with it, but I want to just talk about the different cash flow structures of Fannie and Freddie pools. Fannie Mae pools have always paid principal and interest on the 25th day of the month after the record date. The record date is always the 30th day of the month, so it's basically they pay principal and interest on the 25th day of the following month. The statutory delay that they talk about is 55 delay days, even though in reality it's really 24, 25-day delays, however you want to quote it, from the record date. But when they talk about 55-day delay securities, they're talking about that Fannie structure that pays on the 25th day of the following month. Now, Freddie Mac, prior to 1990, all their pools paid on the 15th day of the second month after the record date. So basically, it's a 75 delay days from the start of the month. Investors pretty much hated that, and it created a real differential in the pricing of Fannie and Freddie pools. So in 1990, Freddie Mac instituted the Gold program for its fixed rate pools only. So basically, they pay on the 15th day of the month following the record date. So it's a 45 delay day, essentially. Now, a couple of things to keep in mind. The Freddie ARMs, for example, are still issued as what they call green pools, the non-gold pools. They're still 75-day delay. Economically, golds are better than Fannies. A 10 days of delay on a 4% coupon at current prices is worth about 3 plus 30 seconds, even yield. But mainly because of liquidity concerns, golds either trade behind Fannies or in line with them. So Freddie Mac has never been able to recoup the extra costs that are associated with financing that shorter delay. And in some cases, they still get their pricing is behind Fannie Mae's, even though their securities are quote unquote better. Some of the reasons for that is the difference in liquidity. If you look at FINRA numbers, Fannie trading dwarfs Freddie Mac trading. There's also some people that say that Freddie pools are more responsive, prepayment. I've never been a huge, I've never really found that argument terribly compelling, but there's some people that believe it. and trade accordingly. And there's also a slight difference in the guarantees that are offered by Fannie and Freddie. But generally speaking, the liquidity is what really causes the concession. Okay, so the new securitization landscape will eliminate the major disadvantage that Freddie Mac's pools operate under, Freddie Mac operates under. So the concession that Freddie Golds trade at is going to disappear because they're all going to issue off the same platform. Generally speaking, Freddie was forced to compensate originators that securitize loans as golds through a MAP adjustment, which stands for market adjusted pricing. One thing to keep in mind too, that that right now, like Freddie 4s, for example, trade roughly even with Fannie's. But in 2016, for example, for the entire year, Freddie Mac's traded, average traded around 430 seconds behind Fannie Mae. So keep in mind, if the economics are better, but they're trading behind, that's a huge disadvantage that Freddie Mac is operated under from a competitive standpoint. So the changes to the MBS market are that the new pools will be created and traded under the UMBS name and ticker, if you will. Fannie or Freddie will each issue UMBS, and they'll be identifiable as either Fannie UMBS or Freddie UMBS. As I mentioned, there's no commingling of loans in the initial pools that are created. They're going to be Fannie only or Freddie only at what they call the level 1 pools. But for level 2 pools, where you're repooling existing pools, then there will be some commingling of Fannie and Freddie pools that will be allowed, as well as REMICs. For anybody involved in that, will have a mixture of Fannie and Freddie pools. So there's, at the resecuritization level, there'll be some commingling of Fannie and Freddie loans and pools, but not at the level 1, the new issued pools. The new UMBS pools will adopt the current Fannie naming conventions. So for example, a deliverable into TBA 30-year pool, all deliverable 30-year pools will be labeled FNCL, which is the current code for Fannie. Non-deliverable pools will have new tickers, and I don't want to go into that here. That's beyond the scope of this. Anybody who wants to talk about it separately, we can talk about that and what the new tickers will look like. Now, the TBA market will be affected in a number of ways. While the go-live date is June 3rd of 2019, trading will begin to transition to the UMBS platform in March of 2019, because the screens actually will start showing at that point. After notification date, they're going to start showing June TBAs. So the UMBS platform is going to start to come into play, and there will start to be trading in UMBS starting after notification in March of next year. The trading screens that people use, like Tradeweb and Bloomberg, are going to change. Fannies will basically convert to UMBS prior to the go-live date, and golds are either going to go away entirely, which is I think Tradeweb's plans, or transition to UMBS, as I'll show you on Bloomberg. It's not clear whether gold TBAs will continue to trade after the go-live date. They won't trade on these electronic platforms. If dealers want to make a market in it, they can. It'll be kind of a phone market, if you will, and it'll trade as long as dealers are willing to support it. The market, for the purposes of the TBA QSIPs, the market's going to adopt the Fannie standard, which is that 01F kind of prefix on the TBA QSIP. That won't change. So here's what the Tradeweb screen is going to look like 90 days prior to conversion. And you can see, and this is for Fannie 2.5s. Obviously, the example's a little dated. I don't think anybody's really originating a whole lot of 2.5s now. But do you see that it shows Fannie Mae / UMBS? Because again, for all practical purposes, Fannie is going to transition into UMBS. They're showing that while they have PC golds for April and May, and they're not showing them any market at all for June, because that's not going. They're not going to show that on the screens anymore. Everything's going to transition to the UMBS. This is 90 days prior to the conversion. Basically, it's after March notification. So it's going to have April, May, and June TBAs on the screen. And here is what it's going to look like 30 days prior. So basically after May notification, where it's just going to show UMBS and Ginnies. And this is the main screen on Tradeweb, but you can kind of see where they're going with this. They're not going to show Freddie Macs anymore, and they're not going to talk about Fannies. They're going to show UMBS, even though for all practical purposes, it is essentially transitioning from Fannie into the UMBS. Now, here's the Bloomberg screen prior to trading. So you can kind of see that their approach is going to be, and this is for 15-year gold at this point. So this is prior to the conversion, and they haven't given them an official date, but the assumption is that the conversion is going to take place after May notification. But you can see here that they're showing April and May TBAs for gold, and in June, what they're going to show on their screen is basically linked to their Fannie Mae screen. So, and then after the conversion, this is what the screens are going to look like. Now, there is one problem, as I pointed out to my contact there, is that, you know, after the conversion date, they're not going to have April and May TBAs anymore. It's going to be showing the June. But the important thing is you can kind of see that up here, they're not going to show anything for gold anymore. It's going to be basically UMBS 30s and UMBS 15s, and for the different sheets that they have up, for lack of a better word. Okay, dollar rolls are also going to transition, and this is the Bloomberg dollar roll screen. And what's interesting here is that what they are planning to show on Bloomberg for the roll trading screen, it's going to reference, if you're trading May, June gold rolls, it's going to show golds in the front month and the Fannies or UMBS in the back month. You can kind of see the front month in this case is they're basically selling the Nugget 3 roll essentially, but in May of next year, it's the Freddies are going to be in the front month, and then you're buying back Fannies in the back month, which is kind of interesting because there was no, you know, I never got a great answer as to whether how this is going to be handled, and also this is what Bloomberg plans to show. What dealers, it's possible that dealers are going to say, hey, we don't want to do that trade, and then Bloomberg's going to have to go back to to square one. But this is the plan at this point for how the rolls are going to be handled in May, you know, as part of the transition or conversion into this UMBS environment. So what the real question is, okay, we talked a little bit before about how complicated it was with respect to this $2 trillion in Freddie Mac pools outstanding. What happens to existing gold pools? Okay, gold pools will not be deliverable into UMBS TBAs. Only pools with 55-day statutory delay will be deliverable into UMBS TBAs. So investors holding the existing or quote-unquote legacy gold pools can exchange them for something that are going to be called mirror pools. The mirror pools are essentially the same. They're backed by the same loans, but basically they're converting them from the Freddie Gold name to this UMBS name, and they're also changing the delay days from the 45-day delay to the 55-day delay. So basically the cash flows will change even though the underlying loans won't. The analytics that are going to be provided are going to allow users to look through the mirror pool to be able to evaluate, see what's going on, what with the pre-existing gold pool. If they want to do some historical analysis on the gold pool, they'll be able to do that by looking through. Now, the agencies and the data providers are going to track how many of each pool has been exchanged and reported daily, because some of these pools, you know, are multi-issuer pools, and they're huge. They're 5-6 billion pools, you know, dollar pools in face value, and not everybody's going to exchange every pool initially. So the agencies and the data providers will report daily on each pool as what's been exchanged. And it will be, you know, highly likely that there will be cases where a Freddie pool will exist and maybe some fraction of it will have been exchanged, but some fraction of it won't have been. It'll be based on who the holder is and what they decide to do. This is the most complex issue in the transition. And it's also, what's interesting is that once the exchange is made, it can't be reversed. So there's no arbitrage that can be done with it. It's basically the permanent reversal. The exchange can take place in a number of ways. You can do it through a dealer, and also you can exchange it directly with Freddie Mac. Now, the exchange mechanics are interesting because if I when the investor delivers or the dealer delivers a legacy pool to, however, you receive back the mirror pool and cash. Keep in mind that there's an economic value to that 10 extra delay days. So basically, theoretically, you're getting back a worse security, and the investors, the holders of that, will be compensated in cash for the value of the delay days, and that'll be a one-time payment that's made as part of the exchange. It's called what they're calling a make-whole payment. Okay, so basically, just to reiterate, what can be delivered against the UMBS TBA are new UMBS pools, existing Fannie Mae pools, as long as they meet the other delivery requirements, and Freddie mirror pools, 55-day delay pools. So basically, everything that's deliverable into the TBA will be 55-day delay. Now, deliverable pools will use the existing Fannie Mae prefixes. So they'll call it basically a 30-year deliverable pool will be a CL pool, for example. The UMBS will continue to adopt this Fannie Mae terminology. Fannie and Freddie UMBS will use similar but not identical pool numbering. So basically, Fannie has been allotted pool IDs with A through I and M. So in other words, if you can see here, for example, a Fannie Mae UMBS pool will be called a CL. This is a deliverable UMBS pool with AB as the first two letters in the pool number, so AB 5678. Freddie Mac has been allotted pool IDs beginning with Q through Z. So you see here, basically the pool number is QA. So you'll be able to look at the pool number and tell who has issued this pool, Fannie or Freddie, as well as in the analytics will also, we're being told that they will also be fields that will show the issuer, but you can also look at a pool and just tell who the issuer is from the pool number. The non-deliverable pools, as I mentioned, will have a slightly different convention from the current. Where it really changes is in Freddie issued non-deliverable pools like the 105 to 125 LTV pools. They're going to go from FG, LMC something. I forget the actual code, but it's like a U6 pool. It's going to go to FH because basically new issue golds won't exist anymore. It's going to go back to this FH nomenclature for the issuance. And again, anybody wants to talk about that, we can go talk about it offline. But just be aware that that's going to change for any non-deliverable pools. Okay, now for those who download their data into Excel, basically not much is going to change, or at least so we're being told. The code for the UMBS TBAs, if you pull it into pricing into a spreadsheet, it's going to stay as FNCL. So in other words, if I have a spreadsheet that looks up, a pricing history on Fannie 4s, after the go live date, I will still plug in FNCL for mortgage and then whatever field I want, and it's going to change. For those who do a lot of their research and analytics based on pulling from Bloomberg into their spreadsheets. For Thomson Reuters, I'm also told that the RICs that they have, the Reuters instrument codes, are also going to stay the same. So UMBS 4% coupons will now be USFN 30, which is the 30-year, 4.0, which is 4.0, equals Tradeweb, which is their coding for doing this into a spreadsheet. So that's not going to change, which is good. That'll make things a lot easier for a lot of people. The aspects of the transition that are yet to be decided. Okay, there are a few things that need to be addressed. Okay, for example, as I mentioned, how long will Freddie Gold TBAs continue trading after the go live date? And that's really going to be decisions that are made by dealers as to whether or not they want to support and actually make markets in Freddie Gold TBAs. It's also, what I mentioned, I showed you what Bloomberg is planning to do with the rolls, but it's not clear to me that dealers are going to support that. So I'm kind of viewing that as kind of to be decided going forward. The plan is that you'll transition there, but it's going to be, because if people are delivering gold pools to dealers as part of these roll transactions, okay, what do the dealers do with these existing golds? I guess they can convert them, but so it remains to be seen. Will legacy gold pools continue to trade? Not clear. if people are going to be able to trade gold pools or whether you'll have to, investors or holders will have to convert them into mirror pools to trade them. And the most perplexing question is the exchange treated as taxable income for tax purposes. The IRS recently made an announcement, quote unquote, that the exchange is not taxable. They're kind of treating it similarly to how the pool modifications worked, but they were kind of studiously vague on whether the make-whole payment is considered taxable income. So some people have reported that they've said it's not taxable. The thinking is that it's probably not taxable, but that has yet to be clearly enunciated to the market. And also how index providers are going to adjust their fixed income indices. There's some changes that are in the works, but anybody that manages to an index, if you're an investor, an investment manager who manages to some, you say the Barclays, fixed income index, how it's going to handle certain aspects of the transition are still to be decided. I think they have some plans in place as to how they want to go, but there's certain subtleties to it as to, for example, the inclusion or lack of inclusion of gold pools. It's not clear yet. I think they're going to make some announcements and make some decisions in the fourth quarter of this year. Okay, so for lenders' purposes, we don't anticipate any sales or any changes being made to those lenders that sell to the cash window. But TBAs are going to change, and those changes are going to impact risk management, accounting, et cetera, and potential issues that we can anticipate are accessing correct prices and durations for the UMBS TBAs. For people, as I mentioned, that download from Bloomberg and Thomson Reuters, it should be fairly straightforward. It should not be a transition. But for it's not, again, clear as to for other people that download, say, from a BlackRock platform, it's not clear that how that's going to be handled. Accounting systems and reports are going to also need to transition, especially for people that use kind of proprietary accounting systems. They're going to need to make sure that the accounting takes these new changes into account. Like, for example, you're going to start having cases where if you have say next year you have May, June, July TBAs on, depending on how you code it, it could be confusing for some people if they have a Fannie Mae TBA in May and a UMBS TBA in June. It's like, well, what is this thing? So you want to make sure that your accounting systems and your accounting system vendors are up to speed and providing information that are going to be able to handle this transition. And for originators that create their own pools, you have to make sure that the pools are created with the correct prefixes for the Freddie and Fannie pools. You don't want to have your pool deliveries be bounced. And you want to make sure all of your counterparties and associated vendors are prepared for the change. That includes clearing firms, custodian banks, and your broker-dealers. In theory, all broker-dealers should be all over this, but you want to be sure and have that conversation with all of your counterparties. Okay, so potential hiccups and disruptions. I mean, the industry has been prepared for these changes, and Freddie and Fannie have been very diligent about preparing people, but there's still potentially possible hiccups. Obviously, the worst case would be massive failure of pool deliveries and such. Don't anticipate that taking place. I think that's a very low likelihood. But some other things that are could possibly impact the market. For example, if custodial banks don't clear the pools correctly, if one or two custodial banks doesn't do it well. Now, what's also interesting is that one of the reasons that they talked about doing it, the rationale was to create a more liquid market for MBS. But one possibility could be if it creates fragmentation, because keep in mind, for example, that some investors have investor limits as part of their investment guidelines. So if they have a limit on, if an investor has a limit, say in Freddie only, and they demand Freddie Mac issued pools and treat mortgage-backed securities issued as kind of as part of those originator limits, and suddenly they start demanding Fannie Mae only pools in their TBAs. That's going to have to be in the TBA market. That's going to be a stipulated trade, which basically trades off the TBA market. And if that happens in a lot of cases where people are stipulating Fannie only or Freddie only, that potentially could impact liquidity and have a less liquid market than we had. That's a possibility. I'm not sure what the likelihood of that, but that's one thing that we're anticipating as a potential issue. We obviously accounting issues, potentially if correct durations and risk metrics are not calculated correctly. Trade assignments, you have to make sure, trade assignment is still a fairly manual process, and you want to make sure that you're assigning, Fannie Mae, 1 month and MBS and others. So that could also be a potential hiccup, especially for anybody that does a lot of trade assignments. And also, with the adage that we like to use is, you don't know what you don't know. And I'm sure, I'm pretty confident in saying that there are going to be things that crop up that we're not anticipating, and/or Fannie and Freddie are not anticipating. But the fact that they're on top of it and communicating very actively and doing very active testing on this in the fourth quarter of this year as well as the first quarter next year makes me comfortable that whatever crops up can be handled. And MCT's role in this is MCT is going to be participating in the testing starting in the fourth quarter of this year. And of course, MCT staff is available to discuss the initiative and how to prepare prior to the go-live date. I'm available. Our traders are available to talk about this, and we want to help all clients and all people involved to make sure that they're transitioning successfully. And as for weather, I have some friends who are like, it's never going to happen. Call me when it happens. Freddie, keep in mind that in creating this CSS, Fannie and Freddie have invested a lot of money in hiring staff and building infrastructure. But the ultimate rule of thumb is, follow the swag. So this is something that they handed out at the conference in May, and so that's how we know that they're serious. That said, any questions that we have now we can field. Please message Ian, and he'll pass them on to me. As well as if anything comes up going forward, feel free to email me at my email address at the bottom, bberliner@mctrade.net. And anybody that's interested, there is some information on the web. For example, Freddie Mac has a single securitization FAQ, and anybody that really wants to dig in can download this adoption playbook that's also available online. So any questions, please shoot them in.
Bill, I'm not seeing any questions at this time, but I'm sure people will shoot them to you directly or share with their traders if they have any. And before we go, I did just want to let everyone know that the recording and the slides for this webinar will be available and sent to all attendees, as well as posted on the MCT website. So, Bill, thanks so much for an excellent presentation. We appreciate having you here.
Great, thank you, and thanks for attending.
Thanks, everybody. Have a good week.